Hi, I'm Steven Van Metre. Welcome to your Wednesday night premiere, where we take 15 minutes every Monday and Wednesday night to try to make sense of the markets. And right now, they don't make a whole lot of sense. You look at the broad market, the S&P 500 large U.S. company stocks, it's effectively exactly where it was 15 months ago. Many investors that bought the S&P 500 15 months ago have made nothing, nada. It's been all over the place. Made no money. Doesn't make it much sense. So the market headed up or down? Where's oil prices going? We're going to answer them both tonight. The content of this video is provided as educational information only, is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by or selling any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. The views expressed in this video or that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. Now, something that most people don't understand is how stocks and bonds work together. There is a symbiotic relationship between stock prices and interest rates. Now, logically, we would say that if interest rates are going lower, that stock prices should go higher because people could borrow money, they could buy stocks. The lower interest rates mean people now will go buy homes, buy cars, TVs, on finance, all kinds of stuff because rates are lower. It doesn't actually work that way. I know it's so confusing because what we would normally expect works the complete opposite. As interest rates go down, it tightens financial conditions. It actually makes it harder for people to borrow. In fact, as we see interest rates go down, we'll look at the charts. It actually tells us that lending demand is falling fast. I mean, it is dropping because when you think about it, let's say that you're a bank, right? And you've got $1 million, $10 million, it doesn't matter, and you want to lend it out. And let's say you want to lend it out to people who want to buy cars. So you go around to the dealerships and you talk to all the finance people and say, hey, look, we've got a promo. We're going to run ads. We're going to pump this. We want to do a whole bunch of car loans at 5% interest. And so you run your marketing campaign, right? And you wait for the applications to come in and none come in. Now, does that tell you, well, gee, I think that people are waiting for interest rates to go higher. So I'll start the campaign again, but drive it up to 6 or 7%. No, it just means there's no demand for loans, for car loans at 5%. So what do? You drop to 4. Oh, hey, new special. 5's out, 4's in. Let's say there's no demand, or maybe there's a little demand. The yield rates go down again. In fact, rates fall until demand shows up. That's how it actually works. So when we look at the broad interest rate market right now, and we see interest rates going down, it says demand is falling. And because of the way investors leverage their bond trade, so investors in the market today, they will short bonds to drive interest rates higher, which means they will borrow a bond from a securities dealer, go on the open market and sell it. And by selling it, they're trying to drive interest rates up. So when interest rates start to go down, these people that owe the dealer the bond back, well, at some point, either they're going to say, hey, you know what, I've made my money, I'm going to end this trade, or I'm losing money, I want to end this trade. So what do they have to do? They have to go out to the market and buy a bond. Now, fortunately, unlike a car, where if I were, say, to borrow your car and sell it with the thought that I'm going to buy it back later at a cheaper price, well, it's probably not going to work because it's not going to be the exact car that you once owned. But a bond is a bond is a bond. So if I need a 10-year Treasury, well, I can go out in the market and get a 10-year Treasury bond. There's lots of them, and they're all pretty much the same. So I can go out and get a 10-year Treasury bond and pay it back to the dealer. Now, how does that work? Well, I have to buy a bond to replace my short. And guess what happens when I buy bonds? Interest rates go down. Now, where do I get the money to buy that bond? Well, I either have to have cash in my brokerage accounts to buy it. And if I don't have a lot of cash, or I've been, shorting treasuries like a madman, then I have to sell my other assets. And what are things that people sell? Well, they tend to sell gold, very liquid, one of the most liquid things on the market. If you want to sell gold, there's a buyer somewhere in the world, kind of like U.S. Treasury bonds. What happens then? Well, then I start selling my stocks to cover my bond shorts. And that's what makes it interesting. So actually, when interest rates go down, stock prices go down. And people don't think that. That's exactly how it works. There's another interesting thing that I want to share with you that I learned this week, and I saw a chart of this, and I've never seen it before, is how crude oil prices are correlated with 5-year Treasury yields. I didn't know it. Now, it's not a perfect correlation, but I'll show it to you, and you'll go like, wow, that's pretty interesting. And it is. So first of all, I want to show you a chart that I'll probably feature Friday, but let's take a look at it. A lot of people are saying right now that the short trade in bonds is over, that all the short sellers have been flushed out, and that is not true. This was posted by zerohedge.com today. The aggregate net speculative position in bond futures, it is still massively short. Yeah, it was shorter here, and it's backed off, but there's still this huge chunk that could go, and it could turn positive. So these shorts could turn into positives, and that tells us that there is a large move still to come in the bond market. So yields can go significantly lower. They haven't done it, but they can. There's all these people who are shorting bonds who believe that interest rates are going higher. And well, interest rates aren't going higher. When you understand how the money supply works, when there's less money in the system, there's less demand. Back to the bank example. Car loans at 5, no demand. Car loans at 4, a little. Car loans at 3, a little more. But I'm still not getting enough to tap out, they say the $10 million I want to lend. Well, when there's less money in the economy, when the economy is creating less money, then people have less money to go out and buy things. And so interest rates fall. I know this isn't this true in all countries, okay? This is not, you can't go to a third world country and say this is how it works. It's just how it works in the United States because we are a reserve currency and we can borrow in our own currency and we have a very speculative, maybe the most speculative stock market in the world where people that want to trade on virtually anything can take a bet and in many different forms, in many different ways on whatever they think is going to happen. So in this case, we have people shorting the bond market. And when at some point that will bring stock prices down. Well, of course, that does beg the question is, well, who's right, stocks or bonds? 90% of the time, the bond market is right. It's very rare. Stock market's more emotional. The bond market, people that trade bonds, understand bonds, they look at the economy from a whole different lens. People that buy stocks generally buy on emotion. So let's go take a look at the charts. And we'll see wherever I left off before I started this. Let's go up to the broad S&P 500. We'll zoom out 2 years and we will bring that in. And here we are, 15 months later. We are right where we were January 17th of 2018. Essentially, yeah, it's been all over the place, but nobody's really made any money. There's no money to be made here. We're sitting tight in this resistance band. This has been a point of resistance repeatedly. At some point, this will likely break down. What we're looking at here is a left shoulder, a head, and a right shoulder. This is a very long topping pattern. If this does prove out to be topping pattern, there is going to be a large reversal in stock prices. And what this is showing us is that large money managers, or smart money, the people at the very top that have all the information, they have been liquidating a large amount of stocks along here, and they're waiting for this thing I shouldn't say waiting, they're letting this thing run out so they can liquidate their positions, and once they're done, the floor drops out. Where does it go? Well, it potentially could very easily get back to down here and its 2016 lows. I mean, it's going to get somewhere right back in here. Some people say it's going to break that. It's possible, but this is an unusually long topping pattern. The 2008 and 9 and 2002 were somewhere around 9-ish, 10, maybe 11 months in there. Nothing quite as long as 15 months, and it's not over yet. But based on what we're seeing here, stock prices are headed lower. Now let's take a look at Treasury bond yields. And you can see here's this big topping pattern that I said all along here. This is a topping pattern in yields. Yields are going down, and 10-year Treasury yields today closed at 2.375. This is not correct because it closes, the software program here closes out Treasury yields a half hour before the market closes. Don't know why, but I just know it does. So what's happening here is it's probably going to find support right at 2.325 because we see here where 10-year Treasury yields have found support. So it's going to probably try to find support here. Now, maybe it will bounce back up to this dotted line here. So you can see, it comes down. Here's a good example, and it kind of bounces back up. So is it possible we'll see that? Yes. If we don't, or it fails to get back much over this resistance line, then you've got a realistic move where this thing is headed back to pre-election levels. There's still a heavy amount of shorts. All those will come out, could see new all-time lows or a repeat of the all-time lows very, very easily. And just to show you the symbiotic relationship between the two, if we go in here and overlay, no, that's not how we do it. Overlay, we've looked at this before. but it is always fun to do. And we can even kind of zoom back on a 2-year, and you can see there's just this gap. I mean, they tend to follow each other pretty closely. If we look at the 6-month pattern, we can see that the S&P 500 should be about 400 points lower than it is now, should be below where it was in December. And that sets up the narrative of what I've said is at some point the stock market breaks from this place. We get a breakdown of the December 18 lows. We get a nice move down in the market. People that are large money managers, hedge fund managers, and all those type of people that have large books of business will be forced to short their own positions to hedge their losses. When the market bottoms, wherever that might be, probably when the Fed taps out, and says, okay, we'll lower interest rates. The market springs back, not because of the Fed lowering interest rates, but because all this short's being pulled off the market. When you pull off a short, you become a buyer. You get a big springboard of stock prices. What happened in 1930, the first 6 months, market rallied 50%. I think we'll see something like that. Will it be 50%? Will it be more? Will it be less? I don't know. But there's such a high concentration in stocks right now in terms of ownership that what you will see is people hedging it. And we've now, from a short volatility position, back in February of 2018, the short volatility complex blew up. We talked about that way back then. And we are now seeing a even higher number of people that are short volatility. So if stock prices come down, then they have to unwind their short volatility positions, and you get just potentially just big drop in stock prices. Makes a really excellent buying position, and also validates that we're in a bear market. How will we know that? Well, that's pretty simple. To find out if you're in a bear market, let's remove that. We need to break down below this December 2018 low. Break there, you've got all the confirmation you need. From a charting pattern perspective, this is what you're seeing as a topping pattern. Now, let's talk about crude oil with our remaining time. So I have said the crude oil is going to revisit its December lows and break through there. So how do we know that that might actually be true? Well, I'll show you if we, actually probably easier if I do it this way. Let's go to the 5-year Treasury yields and let's overlay crude oil. I'm only doing it different because I don't remember the symbol for 5 years, but I know the crude oil one. So, okay, so here we go. Now you can see we are on a 2-year chart. And you can see 5-year Treasury yields are here. And here's crude oil. And you can see the 5-year Treasury yields have gone down while crude oil has gone up. And if we zoom in a bit, you can see let's just go to the 1-year chart. They have a really nice relationship here. So what this tells us is that crude oil should be breaking down below where it was in December of last year. Now, how low it will go, I don't know. And you say, well, this relationship can't be true. And I thought the same thing. So let's zoom out to the weekly chart. Oh yeah, Steve, that doesn't look like anything. Okay, let's go to the 20-year chart and we'll zoom in until we're about let's see. Let's look at this at a year. I think let's try to do this March to March, where it's close enough. But let's just scroll along and then tell me how close these look on a short-term basis. You see they do follow each other? Yeah, because they do. On a big picture, you don't see it. But when you zoom in, looks pretty good, doesn't it? You can just see there it is. So with that, it tells us, with about a minute left, I'm just flipping through charts here. Let's zoom back in. The crude oil is headed lower. Now, what we can also look at is the symbol XOP, which is oil and gas producers. This is a leverage play against oil. Let's zoom out. What we see here is this sideways pattern is going to look like a continuation pattern. You can see it right here in the 5-year Treasury yields, continuation pattern, broke down. I expect the exact same thing to happen here. So just it's kind of interesting to see 5-year Treasury yields being that correlated to crude oil. And of course, when crude oil is obviously tied to oil and gas producing stocks, that stock prices are actually going to head lower and kind of validate my view that we'll break those December lows, create a tremendous buying opportunity, not for many people, but for those who have cash or cash equivalents in their portfolio. There's going to be a potential opportunity because there's still a lot of people that are long crude oil and long oil stocks. Well, they're going to have to hedge by shorting. The computer algorithms will go short too. And then as all those shorts eventually, get pulled off, there's going to be a big springboard. How low it'll go? Don't know. But the charts are telling us and the data is telling us things are going lower, and that's opportunity. I'm Steve Van Metre. I'll see you Friday. Bye now.